All right, thank you all for joining us this evening. This is our virtual meetup, so we rotate between doing live meetups on a monthly basis, and then the next month we do a virtual. So thank you all for joining us. We're going to be talking about 1031s, not paying taxes, which is always nice, right? So you got our Elevate Commercial Investment Group, myself, Cecilia's on here. You got Eric Lopez and Eric Buddiewall, I believe, is on here as well. And then we've got Sean Ross here with 1031X. He's really going to be diving in and telling us all we need to know about 1031s. When we do these meetups, we like bringing in professionals and partners that really know what they're doing in the space. So that's why we got Sean here. We're really excited about this. We just launched a coaching program to anybody that's interested in learning how to do syndications and invest in multifamily on the active side of things versus the passive. We just launched this. So for the first 10 that sign up, we're going to be offering a discount on the rate. So that's the QR code there. If you can go ahead and scan that, it'll give you more details on what that program looks like. About Elevate, we have acquired over 7,000 units, 7,000 multifamily units. We've exited over 1,700 of those units. We've raised over 200 million in equity, a lot of that being through 1031s. And we currently have 650 million in assets under management. This is within multiple markets. I think we're in 7 different states now, good portion in Texas. So what exactly does Elevate do? So we're owner operators of multifamily real estate. We go out, analyze the properties, look for the good properties to buy, analyze them, put together the projections, and then go in and secure the senior lender, put together the investors, whether we're bringing in private equity or high net worth individuals or 1031s, whatever it is. And then once we close on that, we execute on the business plan. We're value add multifamily, so we're going into different classes, right? It could be a nice property, A-class property that still has a value add component to it, or it can be a older C-class property where we're really going in and putting a lot of renovations and fixing it up. And then in doing that, we increase the NOI, which increases the value of the property and gives nice returns to our investors. We're vertically integrated. What that means is, so we've got the real estate arm, Elevate, like I mentioned. We've got J&T Construction that does the renovations and CapEx for the properties. We've got Equity Real Estate Management that does the property management. And then we've also got Fortress Insurance, which insures the properties. So in doing this, we've got a lot of control of how the operations flows, the speed that things get done at, and the consistency. And we're able to really, with having all these things in-house, save money and get these things done at an affordable price. And then as far as 1031 opportunities, like I mentioned, a lot of the properties that we've done this with, a lot of the syndications we've done, we go in structuring it so that we can take in 1031s. So some people think because you're doing a syndication, you can't do a 1031, but in fact you can, depending on the way you structure it. So we're always looking for anybody that's got 1031, a 1031 exchange. We're always looking to help those individuals. All right, and then we got you to our featured speaker here, Sean Ross. So he's been in 20 years of experience, and I'm sure he'll tell you a little bit more about himself as well. But he's the CEO of 1031x.com, and he's helped tons of investors navigate through 1031s. 9 years with 1031x. Nice. So with that said, I'm going to stop sharing. I'm going to let Sean take over here and
All right.
roll with
Now,
it.
you guys let me know when you can see my screen.
Yep.
Okay. I was saying, well, George, Cecilia, Eric, thank you for having me. I'm excited to be here with Elevate. I'm going to go over a 1031 exchanges from a baseline level. And that means I'm going to go over basic rules and procedures and scenarios where it might apply. Now, if we were in person, I would force the audience to raise their hands here and they tell me how many of them have done a 1031 before, or worked with somebody done a 1031 before, or have even heard of a 1031 exchange before. And usually with an audience like this, you get a smattering of hands saying they've heard of one and maybe one or two saying they've done one. or if they have done one, it's been long enough that they just don't remember. 1031 exchanges exist at this intersection of real estate and law and tax and finance. And what that means is you can get in the weeds very quickly, you can get dry very quickly. So I'm going to do a couple of things here to alleviate some of that pressure. The first is I'm going to repeat myself a lot. There are going to be a few basic points that I really want you to walk away from this knowing, and I'm going to say those couple of points over and over again. The other is I'm going to try very hard to not let this turn into a recitation of the tax code or a litany of rules that you need to understand, because the bottom line with any complicated or borderline complicated topic is you don't have to be an expert in it, you just have to know one. And what I'm trying to do here is give you enough knowledge about what the rules and opportunities are that you can know how to apply it in your own circumstance when you need to. Now, I like audience participation. I think every speaker does, because when somebody asks you a question, you're pretty confident that at least one person is interested in what you have to say thereafter. So please do ask questions, and then the Elevate team can let me know what you write in chat. And I'm happy to pause, go back over a topic again. It's also really important if you're sitting there at any point during this presentation and you think to yourself, that didn't make sense, I don't know what that means, I want you to go over that again, I guarantee you're not the only one. So please speak up and say, could you cover that again or give me an example? And I'm happy to do that too. Okay, without any further ado, 1031X is what's called a qualified intermediary. We'll plant a flag and come back to that later to explain what that means, but the punchline is we facilitate 1031 exchanges. We're one of the oldest 1031 exchange companies in the country, been in continuous operation for 32 years now. And we have been consistently ranked as one of the top 1031 exchange companies in the country. Part of that is because we have even in a digital AI age, we have a very human first approach. It's very important to us that we have real conversations with real people as often as we can. Another reason is which are staffed by rock stars. My team is full of dedicated individuals who really obsess over the success of our clients and the other businesses that we work with, like Elevate here. We have physical offices in Denver, Cleveland, Dallas, and Springfield. Denver is our headquarters. We grew out of the Rocky Mountains, and I'm personally from Denver, Colorado myself. I spent quite a few years in the banking and finance and equities space before kind of falling ass backwards into 1031 exchanges. And what I found here is you get to work with lots of interesting people. People that invest in real estate and who are serious about it tend to be outside the box thinkers, tend to be smart, tend to be successful, exactly the kind of folks that you want to spend your days working with. We have post-COVID, this certainly became true, but it's a very digital-friendly platform, as we can perform 1031 exchanges remotely in every state in the country and do so every single year. We even perform international exchanges from time to time. What I'm going to go over for the next 45 to 60 minutes is what a 1031 is, how to spot a 1031 opportunity, why would you do a 1031 exchange, what's the end game of performing one of these, what are the important rules that you need to walk away from this knowing, what properties and what kind of investors qualify for 1031 exchange, because there are some exceptions that aren't exactly obvious, and some potential 1031 eligible properties that aren't exactly obvious either. And then just as importantly, if you're doing a 1031 exchange, what are your responsibilities as the investor? And then depending on time and depending on just how much of my voice I have left, we'll do a light touch on some advanced exchange strategies. Again, none of those are intended to turn you into a 1031 expert at the end of the day. What instead I want you to know is kind of the breadth of what's possible when you really dive into this part of the tax code. So to start with, a 1031 exchange comes from Section 1031 of the Internal Revenue Code. And you can see a snippet of that at the bottom of this slide. It's a way to transition out of an asset, a capital asset, specifically nowadays real estate, although it used to apply to more types of property, and into another one without recognizing gain on the sale. So traditionally, the sale of a business or investment property, if it's been heavily appreciated or depreciated, would trigger taxable income in the year of sale. With a 1031 exchange, you reclassify what you're doing as a sale into an exchange, and you can skip over the step where you recognize income. And if you don't recognize income, you don't pay taxes. So that's the magic of the exchange, if you want to put it that way. So you can sell business or investment property without recognizing taxes, but there are lots of parameters that the IRS and the Treasury regulations put in front of you that you have to follow if you're going to do this in a valid way. So there's a known specific legal procedure. You have to reinvest into qualifying assets, in this case, other business or investment property. And happily, although this has been challenged in recent years, there's no limit to the number of exchanges you can do. That's at one time, within a given year, or across your investing lifetime. Lots of people have built a tremendous amount of wealth in real estate and paid very little in taxes because they continue to leverage 1031 exchanges over and over again to either trade into bigger doors or more doors or both. The last line here I want to double click on. And when you do a 1031, the taxes are deferred. You're just kicking the can down the road. You do not eliminate the tax liability. If those of you who have sold a primary residence before are familiar with Section 121 of the Internal Revenue Code, which says that you can sell your appreciated primary home, and then a certain amount of the capital gain that you've accrued during your ownership period is exempt. You can take the cash straight from closing, do what you will with it, does not count towards your income for the year. That's not true with 1031s. 1031s are just a deferral strategy with a couple of exceptions, and I'll get into those in a minute. In terms of what you can defer, this pie chart's a little misleading, but it gives you a sense of the kind of taxes that a 1031 exchange helps you jump over. Depreciation recapture tax, for those of you that have held qualified investment property for some time, know that you get to take a depreciation deduction off of your income every single year, and that lowers your tax burden during the years that you own the property. Well, when you sell property, the IRS takes all the depreciation that you could have taken and they add it up and tax that at 25%. That is deferred with a 1031 exchange. All of your long-term capital gains taxes are deferred. All of your state income and capital gains taxes are deferred. That's true in all 50 states. Pennsylvania used to be a holdout for a very long time, but a couple of years ago, they finally joined the party and started allowing 1031 exchanges to defer Pennsylvania state income taxes. And then the Affordable Care Act surcharge tax, sometimes called the net investment income tax or the Obamacare tax, that is applied to investment income past a certain threshold. That's also deferred with a 1031 exchange. We do, we've done tens of thousands of exchanges all over the country. Our modal client has a potential tax liability when usually between 22 and 28% that they're deferring from the value of the real estate that they're selling. That's pretty typical in terms of what we see that people are deferring when they complete a 1031 exchange. I mentioned the taxes are deferred and not eliminated. So why would you do that? Why kick the can down the road? I'll come back to this. The primary reason, and for those of you that have read about or studied the time value of money, it's just an increase in your available capital. You have more equity to roll into your next investment, and when you have more equity rolling into more equity, the snowball that is your portfolio and potential portfolio value and potential cash flow just keeps growing and growing faster and faster. So it's a way to turbocharge the growth of your portfolio. It also gives you increased flexibility. So let's take a quick example. Let's say you're invested in a multifamily building in Denver, Colorado. Denver's something I'm very familiar with. You're invested in Denver, and you decide it's really hard to be a landlord here now. It didn't used to be hard to be a landlord here, but a bunch of Californians moved into the state and they brought their legislation with them. And now it kind of sucks to be a landlord. I want to go be a landlord in Texas. So I want to change the geography of my investment. I'm not really out of the real estate investing game. I just want to go somewhere else. Well, if you did that without a 1031 exchange, there'd be a big barrier, which is you'd owe a lot of money in taxes if you just sold the property and moved and bought something else in Texas. Well, 1031 allows you to skip over the disincentives for changing your portfolio. It also gives you more control over when you face taxes. So you can imagine a scenario where let's say you're in a certain income tax bracket today, but maybe when you're retired, or maybe in 10 years, you'll be in a lower income tax bracket. Or maybe you don't have any passive losses or active losses to offset future income today, but you might down the road. So 1031 exchanges allow you to change your portfolio and then have a taxable sale when you think it's most advantageous for you. And the last one is the big ticket item. There's really real big estate planning considerations for 1031 exchanges. I'm going to spend a little bit more time on that here. Real estate investors get more tax breaks and better tax rates than any other kind of investor out there. And the reason for that is Congress has repeatedly wanted to incentivize people to keep money invested in real estate to build more properties, better properties, update properties, and they want to encourage home ownership. And a lot of those benefits uh, accelerate when you die. And what I mean by that is you can have a portfolio of, let's say, 15, 20 properties. And then when you die and you pass on that portfolio to your children or whoever your heirs are, they get what's called a step up in basis. And the step up in basis means that the difference between what the IRS says the property is worth for you from a tax standpoint and what the property is worth if you were to sell it on the marketplace, which is where capital gains are calculated, that difference evaporates. The tax basis in the property resets to current market value, which means that you could sell the property the next day and there'd be no capital gains tax whatsoever. That strategy of doing 1031 exchanges after every sale, building a larger portfolio, and then passing along those properties to your heirs as inheritance is how families build multi-generational wealth in real estate. There's a kind of a macabre expression in our industry, swap till you drop. That's referring to this exact strategy. Do a 1031, do a 1031, do a 1031, kick the bucket, and then your kids can sell the property and won't face taxes. There might be estate taxes depending on the size of the estate that you pass on, but there won't be any capital gains taxes on the real estate if you follow that exact model. Okay, so preamble about why you might do this and some of the advantages out of the way. How does a 1031 exchange actually work? If you Google or ask ChatGPT about 1031 exchanges, you're very frequently going to run into the term like kind. The IRS says you have to trade out of property into like kind property to effectuate a 1031 exchange. We're going to spend some more time in a second talking about what like kind is. And the tax basis in the property that you've sold is going to carry into the new property plus any increase in value. Now, this is a very short accounting lesson. You don't really have to pay attention to this unless this is the sort of thing that interests you. But here's a quick example. If you sell a duplex for $750,000, and let's say its tax basis is $550,000, what does that mean? That means maybe you bought the property for $550,000, or maybe you bought it for $600,000 recently and depreciated it by a little bit. If your tax basis is $550 and you sell at $750, that's a capital gain of $200,000. If you do a 1031 exchange into a small commercial building for about just shy of $1 million, the new tax basis in the new property that you've acquired is going to be $700,000. That's the original basis of 550 carrying over into the new property, plus an increase in the value, the difference between the 750 and the 900. So that 550 plus 150 means you have a new tax basis in the new property of $700,000. Why am I mentioning that? The reason is if you look at the gap between the tax basis and the value of each property. So you had 550 and 750 for the first property and 700 and 900 for the second property. It's still a $200,000 gap, i.e. the tax liability hasn't gone away. You've just pushed it into the new property. So if you sold the new property the next day without a 1031 exchange, there'd be a $200,000 capital gain, just the same as the property you exited. Now, if there are any accountants in the room, you'll know that I've oversimplified this. There's more considerations that go into calculating potential tax liability, but for the purposes of our conversation today, this is good enough to get by. Okay, back to the concept of like kind. Like kind is a really terrible term. I'm going to get on my soapbox for a second here. The IRS says you have to trade into and out of like kind property, and like kind, if you just read it, sounds like it means if you're selling residential property to trade in a residential property, or maybe even single family to single family, or from one state to the same state. If you go to the IRS's website and read their definition, which is right in front of you on the screen here, you don't have much better sense of what like kind actually means. So, what qualifies for a 1031 exchange? The way that I like to think about it is any kind of real estate held for business or investment use can be exchanged for any other kind of real estate being held for business or investment use, with a few exceptions. So we'll go into a few examples of this. Actually, let me just skip straight to this slide here. Everything that you see on this checklist in front of you is all real estate that could be exchanged for each other. Now, this list of assets have very different use patterns, very different average values, very different depreciation cycles, useful lives. Some of them aren't even classic real estate in the way you'd think about it, but all of them are defined as real property, and real property is exchangeable for real property. All real property is like kind to real property, provided that the use is business or investment property for the long term. And I want to highlight for the long term because here's a list of assets. I'm going to jump back in a second here. Here's a list of assets that don't qualify for 1031 exchange. I'll give you guys a second to look over that, but there's a few I want to highlight. Held by developer, flipper, or dealer, those are all effectively saying the same thing. It's possible to hold real property for a business or investment purpose and it not qualify for 1031 exchange because the IRS says you're not actually an investor, you're a dealer. And for dealers, real estate is not a capital asset, it's inventory, because you're in the business of building and flipping and selling or improving and selling real estate. That turns it into inventory. Inventory is not eligible for capital gains treatment. So, unfortunately, a lot of people that are in the fix and flip space, or a lot of developers, their assets are not eligible for 1031 exchange much of the time. There are scenarios where it could be, but much of the time they're not. There's another that I want to highlight here, which is REIT shares. So, those of you who are familiar with real estate investment trusts, you're investing in real estate. Unfortunately, because of how they work, you're not actually buying the real estate. You're buying shares in the trust. Shares in the trust are not real property, not like kind to other real property, not eligible for 1031 exchange. Okay, we'll come back to that list in a second here. Let me just highlight that for property to qualify for 1031 exchange, it does not have to generate revenue. And it can be acquired with the intent to immediately 1031 exchange out of it. I'll explain in a minute why you might want to do that. And critically, and I like highlighting this, there's no minimum holding period requirement. A lot of people believe that you have to hold real estate for either 1 year or 2 years before it qualifies for 1031 exchange. And that's not true. What matters to the IRS, and this is true for state departments of revenue as well, what matters for the IRS is what was your intent at the time of acquisition? If your intent at the time of acquisition was to hold it for long-term business or investment use, that's enough. Then maybe the market changed, life circumstances changed, you got a better strategy in mind after a period of time. To give an example of this, my former business partner, one of the attorneys that founded this company, he bought a commercial building out of a 1031 exchange. And then 3 months later, a hospital came by and knocked on his door and said, "This building would make a lovely parking lot for us. Why don't you sell it to us?" So he did. 3 months after he bought it, he 1031 exchanged out of it again. And he was able to do that because he didn't intend to flip it in 3 months. He just got a great offer and took the offer. That's a valid 1031 exchange. I mentioned that it can't be held primarily for sale, developer flipper, and it can't be held primarily for personal use. So primary homes aren't eligible for 1031 exchanges, and you wouldn't want to anyway. There are just better tax treatments for primary homes. And vacation homes very often are not eligible for 1031 exchange. Although in an era of Airbnb and VRBO, you see a lot of lines blurred here. Well, people will have a vacation home that they spend a lot of time in, but they also rent it out when they're not there. And that really is a case by case fact pattern. If you're in a spot like that and you want to sell that property, it might be eligible for a 1031 exchange, but it might not. It behooves you to talk to somebody with 1031 knowledge to figure out, okay, How did you use it? What's the fact pattern? What's the intention? What are you going to do next? All of those will help determine whether or not you're at audit risk if you try to 1031 exchange the property. It's also tricky to trade into property, to buy property that's held by a related person. So you might have, I want to buy a small multifamily building, and I want to hold it for long-term use, and it matches all the other criteria that the IRS says you need to be eligible for a 1031 exchange. But the person who owns the property is my brother. That's a red flag. I won't get into why the IRS doesn't like that. It has to do with a process called basis shifting that a lot of wealthy families used to use to lower their tax burden. But if you have trying to buy property that's held by a related person or related entity, then you want to double check with a real estate attorney or with a 1031 expert about that. It's also not easy to anticipate who a related person is. So, for example, my father is a related person to me, but my stepfather is not. My brother is a related person to me, but my cousin is not. My mom is related to me, but my mother in law is not. So there are circumstances that sound like it might be related that aren't, and there are some circumstances that sound like they wouldn't but are. Okay, we've talked about what qualifies for a 1031 and why you might want to do one and what you defer if you do one. If you want to defer all of the taxes that you otherwise would have owed upon sale after selling your property, you need to clear two hurdles. You need to buy replacement property or properties, because you can buy more than one, that are worth at least as much as what you sold. And this is there's a lot of misnomers out there or bad information on the internet or poor assumptions about 1031 rules. This is one of the more common ones. Very frequently, an investor will come to us and say, okay, I'm selling a property for $2 million and I have a $500,000 capital gain. So I want to roll that $500,000 into a new property. Or they'll think, I'm selling a $2 million property and I want to, after I sell it, I have an $800,000 loan. So I want to take the $1.2 million in equity I have and I want to roll that into a new property. Well, that's not enough. The IRS says what you replace it with has to be worth as much as what you sold, not just what your capital gain was, not just what your equity in the property was, but the market value of what you exited. So if you sell a $2 million property to defer all of your taxes, you want to reinvest at least $2 million worth of new property, new valid, like kind, eligible 1031 exchange replacement assets. That's the first hurdle. The second hurdle is all of the equity has to roll into the new properties as down payment. You can't take cash out at sale and then buy. So in the example I gave, $2 million with $1.2 million worth of equity. Let's say you wanted to roll into a $2 million property, but you only wanted to put $700,000 down and you wanted to do a 65% loan to value on the new buy. That doesn't work because not all of the equity rolled into the new property. It'd be $500,000 short on the equity requirement in that example. Now, it's possible to roll the equity into a new property and refinance and pull some equity out later that way. That's a pretty common strategy. But as long as you clear these two hurdles, equal or up in value, equal or up in equity, then you defer all of the taxes, all the ones on that pie chart that I showed you earlier, through your 1031 exchange. Speaking of misconceptions, very common misconception on the internet is that you have to have as much debt on the new property as you had on the old property. So equal or up in debt. And while that is technically true, it's practically false. So it's technically true that the IRS will flag something if you don't have as much debt on the new property. There's lots of debt offsets. And there are lots of examples where people have less debt on the new property and still defer all their taxes, usually by supplementing it with outside cash. So if in an example where you sell a $2 million property and you have an $800,000 loan that you pay off when you sell, you could buy another $2 million property with no debt as long as you found another $800,000 from somewhere. Maybe you liquidate some stock or you just have it in a savings account somewhere. If you're liquid enough, you could just put pure cash down on the replacement property, and that counts as a debt offset, and that's a totally valid 1031 exchange.
Hey, Sean,
Yeah.
got a couple questions. So I had one myself. Who kind of determines, so you're talking about the flippers. Who's to
Mm-hmm.
say that I'm not purchasing the single family home to rent it out, but then I decided to sell it.
That's a
Like
good
who?
question. The short answer is this is more art than science in a lot of ways. So when you report a 1031 exchange on your income tax return or your entity's income tax return, you do it through something called a Form 8824. It's a 4-page document. There's 4 sections, and 2 of the sections you almost never really fill out. So it's really just 2 sections, and in those sections they ask you, what'd you sell, what'd you buy, how much were they worth, and then you do a capital gain calculation to see how much you're actually deferring. They don't ask you how you're going to use the new property. They don't ask you if you followed all the other 1031 exchange rules. They just have that piece of paper. The only time the IRS ever tries to figure this out, or a state Department of Revenue, is if you get audited. And if you get audited, the auditor is going to come to you and say, tell me about the property you bought or the property you sold. And they'll want to know the fact pattern. And I mentioned that 1031 exchanges are just as much about intent. What's your intent at the time of acquisition? Well, intent is subjective. It's your word against theirs, really, but they want evidence of your intent. So, how do you provide evidence of your intent? One way you could do it is by, say you tried to rent it out. Well, did you post did you list the property for rent anywhere and where and for how long? Do you have a fact pattern, a history of buying and selling lots of properties over and over again? Because if you let's say you buy and sell 6 properties every single year, and for all of them you try to claim that they're 1031 exchange, that you just, you know, I wanted to hold it for 2 years, IRS, I really, really did, but it just didn't work out for the 8th year in a row. Like at a certain point, that's a hard argument to swallow. There's a lot of other potential red flags and green flags along the way to convincing an auditor about the correct intent, but it really is an artful argument at the end of the day.
Got it. Got it. And then the other question that came up here in the chat was, as far as syndications go, is it possible for a syndication to do a 1031 into another deal?
It is. So there's 2 things to talk about here when it comes to syndications. The first is, can the syndication itself, so let's say you have a syndication and you've got you sponsor your general partner, you got your limited partner investors on the side, but it's all one entity. Can that entity perform 1031 exchanges? Yes, it can, provided that it follows all the other rules and the other fact patterns apply, right? If the yeah, I suppose if you imagine a syndication, I don't know why you would do this, but imagine a syndication that just fix and flip properties over and over and over and over again, every 2 months. They probably would be classified as a dealer and probably wouldn't be eligible for capital gain treatment and probably couldn't do a 1031 exchange. But yes, on the entity level, you certainly can. However, individual investors who are participants in the syndication, can they do a 1031 coming out of the sale of the syndicate asset? And that really depends on how they hold tight, what they've acquired with their investment. So if all they have are partnership interests, then no, they're not eligible for a 1031 exchange. But if they own underlying interest in the real estate, what we call fee simple interest, or there are other ways of owning real estate that are also eligible, then yes, they can do a 1031 coming out of a sale. Very common to have what's called a 1031 sidecar in one of these. So you'll say, we know we want to raise $10 million from investors who aren't in 1031 exchanges, and they just come in as traditional limited partners or limited investors into the project. But we also want to raise $3 million from 1031 investors. So that $3 million is going to be carved out, and they're not going to buy partnership interest. They're going to buy undivided interest in the real estate, and they'll own it as tenants in common with the syndication. Not the only way to do it, but that's the simplest way to do it. When they sell, if they're still owners of the underlying real estate, then they can do a 1031 too, even if the rest of the investors in the syndication don't want to do a 1031 out of sale. In that case, they're also sellers. They'd be listed on the contract as additional sellers, and they would have a separate settlement statement, and you'd go through a whole closing process of their own. But the punchline is yes, but it depends for both.
Is it true that if only a portion of them are going to do it, all the funds get held up until that 1031 is complete?
It depends on how it's structured. So we're we're just going to start dancing on the edge of a more complicated conversation, and we're not going to stay there very long.
Yeah.
But I'm happy to answer questions about it after the presentation's over, which is if the entity is going to do a 1031 exchange, and a whole bunch of the investors are all for it, but a couple of them really aren't. Well, sorry, the entity is the one receiving the income, potential income from sale. The entity is the one that has ownership interest in the real estate, and it's the entity that's going to do the 1031 exchange. Your participation in the entity can't be extricated at closing, and then you can't go your separate way. But you can effectuate something that's similar to what's called a swap and drop, or probably a drop and swap, where you might be able to, depending on the structure, deed out interest to a participant and say, okay, you don't have to participate in the 1031 exchange. Before closing, we're going to kick you out of the entity and you're going to own a small bit of the real estate. And at that stage, you can either decide to do your own 1031, a separate one, or cash out or do a partial, lots of options there. But it has to be structured correctly well in advance of closing. Ideally, before a contract is even signed, a
Mm.
sales contract, you want to have an idea of who wants to do a taxable sale and take the cash, who wants to do a 1031 exchange, what do the entity documents say is allowed here. You really want a real estate for a syndication. You want a real estate attorney involved in that conversation pretty early. And if you're an investor in a syndication, you probably want your the deal sponsor to recommend an attorney or have an attorney for you to speak to, because that path is riddled with potholes.
Yeah. Okay. That helps. Yeah.
Okay. Any other questions before I keep going here?
No, you can continue.
Okay. So here's a quick example when I was talking about you don't have to replace the same debt in the new property. So you can look at the values here for the property that was sold, which we call the relinquished property, and the property that was acquired afterward, which we call the replacement property. Both of them $500,000 properties, but in the first property, they paid off a $180,000 note at closing, and they only got a $80,000 note. Maybe it was a loan from a family member or owner or seller financing on the replacement property. But to make up the difference between the equity they had rolling over and the amount of money they borrowed, they supplemented it with 100 grand of outside cash. This is a perfectly valid 1031 exchange, even though you have less debt on the new property. Okay, now we're at the point where I want to ring the bell and say, if you're in an active exchange, you're going to be in a 1031 exchange soon. This is the most important rule for you to know about from a practical standpoint. That is, the IRS puts you in a narrow box when you start a 1031 exchange. And that narrow box is from the date that you sell, you only have 45 days to identify what you might want to buy next. You have 6 months to complete your exchange, but you only have a month and a half from the date of your sale closing to identify what you might want to buy next. And we'll spend a little bit of time talking about that. But to add some color to this, per our data, every year, somewhere between 8 and 10% of our exchanges fail, our clients' exchanges. And by fail, I mean they started a 1031 with the intent to buy something new and defer their taxes. They sold their property and they did not reinvest into qualified property and did not defer their taxes, or didn't defer as much of their taxes as they want. 8 to 10%. Of that 8 to 10%, the vast majority are because they failed the 45-day deadline period. That is, they did not identify qualified real estate within the first 45 days, or they couldn't buy something they identified within the first 45 days. So if you're entertaining a 1031 exchange, it really behooves you to try to line up what you want to buy next early, because that month and a half goes by very quickly. That's 45 calendar days. You don't get breaks for weekends or holidays. At the date you sell is day 0. The next day is day 1. By midnight on day 45 thereafter, you have to present a list to your 1031 company. And at that point, the list that you present must contain the property that you're eventually going to buy. Otherwise, you can't complete your 1031 successfully. Now, there are more identification rules that we could spend more time on, but the vast majority of our clients fall under what we call the 3 property rule, which is you can only identify up to 3 potential replacement properties by the end of the 45 days. Now, you can change those 3 properties as many times as you want from day 0 to day 45. So let's say I identify properties A, B, and C within 10 days of my sale, and then somebody else buys property B, so I go out and find a new property B for my list while I'm still in my ID window. But at the end of day 45, your list is frozen in place. You can't change it anymore. There are some circumstances where if there are natural disasters that affect property, you can get an extension, but those are pretty uncommon. I mentioned the 3 property rule. It's technically possible to identify more than 3 properties, but arbitrarily, the IRS makes it really, really hard as soon as you do that. So one of 2 things has to be true if you identify more than 3 properties for your 1031 exchange. The first is the combined value of everything you ID can't exceed twice what you sold. So if you sell a $2 million property and you want to identify more than 3 potential replacements, the total market value of what you identify can't exceed $4 million, or 200% of what you sold. Now, that doesn't sound too bad until you start thinking through the logic of it. If I know I need to buy a $2 million replacement property, well, now I can't identify 4 or 5 or 6 $2 million properties to trade into, because that blows straight past the 200% rule. For the 200% rule, the average market value of the properties identified can't exceed $1 million in that scenario, which is half of the value that I need to trade into to defer all of my taxes. There are scenarios where the 200% rule makes sense. And to give you an example, last year we did an exchange for a gentleman out of Hawaii. He sold 1 property and he traded into 27 new properties. So in that scenario, he had to identify a lot more than 3 properties. And the total value of what he identified was a lot more than what he sold, a lot more than 200% of what he sold. So in that case, he fell under the 95% rule. The 95% rule says you can identify as many properties as you want, and they can be of any market value you want. But your 1031 fails unless you buy 95% of all of the value that you identified. So it means you can't miss out on it. Like if you identify a property under the 95% rule, you pretty much have to buy it. You can't let somebody else buy it for you. The seller can't change their mind. You really have to have those ducks in a row if you're going to go that way. It's really, really uncommon that we have people choose the 200% rule or the 95% rule. My guess is something like 95, 97% of our exchanges just use the 3 property rule because it's that much simpler. It's difficult to comply with from a practical standpoint, but it's a lot simpler from a rule navigation standpoint. Okay, another rule that you should care about, called the same taxpayer rule. That is, the person or entity that sells the relinquished property, the property to kick off the 1031, has to be the same taxpayer, same tax filer that buys the replacement properties. So let's imagine that George and I owned 2 companies together. We have Company 1 and Company 2. Company 1 sells a property, and we think, well, we would love for Company 2 actually to buy the next property for whatever operational reason. We might have a legal or practical reason wanting Company 2 to own the next property. Can't do that. The reason you can't do that is, I mentioned Form 8824, how you report a 1031 exchange. That can only be applied to 1 income tax return. If George and I own 2 companies, that's 2 multi-member companies, those have to be separate taxpayers. So we can't start a 1031 exchange on Company 1's tax return and end the 1031 exchange on Company 2's tax return. It has to be 1 tax filing reporting the purchases and the sales. So you have to have the same underlying taxpayer. With married couples, it gets a little bit, there's more flexibility there. And entities owned by married couples, especially in a community property state like Texas, there are some more flexibility there. And for people who bought a property and have since divorced or are divorcing, there's some additional flexibility there under Section 1041. But most of the time, a good rule of thumb is the name on the title to the property being sold should probably be the name on title to the property being acquired. Okay. Now, I say that you don't have to have the same name. So it's possible that, let's say, George and I own 2 companies, Company 1, Company 2, but they actually both roll up into a Master Company 3. And Master Company 3 is the ultimate taxpayer. So in that scenario, Company 1's name can be on the sale property, Company 2's name can be on the replacement property, But because they all roll into the same master tax return, then that's fine. It's still reporting a 1031 exchange on one. Or another scenario, and this is more common. Let's say you bought a property initially in your own name. Let's say it was just the first primary home you ever bought, and then you converted it into a rental down the road after you bought a new property. Well, it's in your name, but you want to own the next property in an LLC because the internet told you that's a good idea. Well, okay, you can do that as long as the LLC that owns the new property is a pass-through entity and reports on your personal income tax return. All that's totally fine. Now, George, the question you asked earlier highlights a couple of really problematic areas in the tax code, which is what happens if not everybody wants to exchange together, or what happens if some new investor wants to participate in the acquisition of the new property, but they weren't on title to the old property. We're not going to spend too much time on those, but you should really talk to somebody well in advance of your 1031 exchange if you're going to do that, because dropping out of partnerships or adding new investors in the middle of a 1031 exchange is really, really difficult. Hard to do. Very easy to fail an exchange. And especially if you're in a state like New York or Illinois or Hawaii or California, places where the state tax authority and revenue authorities are desperate to twist the screws on people so that they have to pay more taxes. They like to scrutinize deals like that. California especially is notorious for making it very difficult to engage in any kind of partnership navigation in the middle of a 1031 exchange. Okay, let's give you an example. Actually, this is some of my favorite slides in the entire presentation. And for those of you who are football fans, this analogy will be familiar to you. So partnerships can buy and sell as a partnership, like we talked about. Individual members in a partnership can't exchange separately because they're not the underlying taxpayer. The partnership is the underlying taxpayer. So what happens if George and I are invested together, but we don't want to be invested together in the next property? And this happens all the time with family members or friends who invest together or people who used to be married but aren't anymore. So here's an example. Let's imagine an LLC called Six Rings LLC that's selling a property in Massachusetts. The two members of the LLC are Bill and Tom, and Bill wants to exchange into another property in Massachusetts, but Tom doesn't. Tom wants to go move down to Tampa, Florida, and buy a property in Tampa, Florida. They don't want to continue the partnership anymore. How do they do this? Well, the first way they could do that to navigate around all the rules we've covered so far is Six Rings LLC could buy both the property in Massachusetts, the new one, and the property in Florida. So they buy the property Bill wants, they buy the property Tom wants, and then after the 1031 is over, they can dissolve the LLC and distribute out the two properties to each other. The problem with this is that when you do a tax-free dissolution of an LLC, you have to distribute out the properties pro rata, which means equivalent to the amount of ownership that each of the members had in the partnership. Well, we're assuming it's 50-50 here. Now, if Tom and Bill bought two properties and want to distribute out the Florida one to Tom and the Massachusetts one to Bill, unless those properties are of the exact same market value, it's not a 50-50 dissolution at that point. So someone's going to owe somebody else some money if you follow this strategy. If the property in Florida is worth more, then Tom, who receiving that property, is going to have to owe some money to Bill for the dissolution, and he's going to pay some taxes on the money that he transfers over to Bill. So this is what's called a swap and drop. You swap into new properties, then drop out of the partnership. A more common solution is called a drop and swap, which is Tom and Bill don't want to invest with each other anymore. So they dissolve Six Rings LLC. It files a final tax return to the state of Massachusetts. And then now they own the original Massachusetts property 50-50 as tenants in common. Tom owns an undivided 50% interest. Bill owns the other undivided 50% interest. Now when they sell, it's two separate sellers engaging in the 1031 exchange. And at that point, they can do whatever the hell they want with their proceeds. Tom can reinvest in Florida. Bill can reinvest in Massachusetts. One of them could change their minds and have a taxable sale, and it won't impact the other person's ability to do a 1031 at all. So this is the drop and swap. And drop and swaps are much more common than swap and drops. And we probably see this, I wouldn't say in more than 5 or 6% of our exchanges, but it's when it comes to partnership issues that get resolved, this is almost always the formula that's used. Now, it's been best industry practice to have the drop out of the partnership, the dissolution, take place months and months before sale. However, last year, maybe it was late in 2024. Now I can't remember. In the state of New York, there was a very promising tax case where the partnership dissolved at the date of closing. So it was a partnership all the way through. The partnership negotiated the sale agreement to the buyer, showed up at closing, and then at closing they said, no, we want to go our separate ways for a 1031. They dissolved the LLC and did that. Usually that would be scrutinized and overturned, but the tax court in New York said, no, 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 that's fine. We actually like that fact pattern. The other states haven't adopted that. I don't know that they will, but if that happens more and more often, then you can be a little bit less careful about how you navigate these down the road. Okay. Before I get into what a qualified intermediary does, or do we have any other questions that I can answer at this time?
Yeah, there's one that just came in. It's what if a partner dies,
Mm,
I guess before the 1031 or during the 1031?
yep. It's a good question. If a partner dies, and let's say it's a normal LLC, right? And there's three members, so each of them, unless the operating agreement states otherwise, own a third of the underlying assets. One of the partners die. Well, if they have an estate plan, then somebody else might be inheriting that interest in the partnership. Maybe the other partners inherit that interest, but maybe not. And if there's not an estate plan in place, what happens to their estate? Is there a probate period? That can get hairy very quickly. There might even be a clause in the operating agreement that says if one partner passes away or is incapacitated for X number of, under these conditions, then the other partner has the ability to purchase or just receive their interest in the partnership. All of that's possible. The punchline here is the facts on the ground matter, right? There's no defined way that's handled. The partnership interests that the partner have are an asset. That asset has to go to somebody. There are probably rules in place in terms of who receives it and how and when, and if there's compensation paid for the receipt of that asset. Um, I couldn't, you have to have a specific scenario in place. And even there, I'm not a real estate attorney, right? I don't want to pretend to be one on TV. So I'm dancing at the edge of my knowledge anyway, talking about this, but it would be a case by case basis.
Yeah, that's what I was thinking. It'd be more of what's in your operating agreement for that entity and
Yeah.
how it spells it
Yeah.
out.
Now, if it's a less traditional partnership, if it's a trust or if it's an S corp. By the way, just word of the wise out there, there are very, very, very few reasons to ever hold real estate in a corporation. S corp or C corp, it's generally not a good idea. Please don't do it. It makes 1031 exchanges very hard too, especially if all the partners don't want to exchange together. So just some free advice there that you didn't come here for.
Hmm.
LLCs are much cleaner for partnership or tenants in common agreements are much cleaner for partnership than corporations are. Okay. Any other questions?
No.
Okay. So back to the role that my company serves, qualified intermediary. We exist because the IRS says we have to. You, as the seller doing a 1031 exchange, are not allowed to do a 1031 all on your own. There's actually one very narrow scenario where you can do it on your own, but even then, it's not advisable to try, and it almost never comes up. So, for the vast, vast, vast majority of 1031 exchanges, you're not allowed to prosecute it on your own. You have to use an independent third party to act as the intermediary. Now, there are rules about who your intermediary can and can't be. Can't be a relative. It can't be your attorney, your accountant, your financial advisor, your broker. It can't be an insurance rep, which is why you don't see law firms that have in-house 1031 companies. It's why you don't see brokerages that have in-house 1031 companies. It's why you don't see private equity groups very often that have in-house 1031 companies, because you're not allowed to perform both roles at the same time. So we exist as an independent intermediary, and all we do are 1031 exchanges. Our legal role is to create distance between the person selling the property to kick off the exchange and buying the property to complete the exchange, legal distance from the sale or purchase itself. Now, if you really dig through, and you probably shouldn't want to do this, but if you do, if you read the Treasury regulations on this, you'll see that the 1031 company is actually the entity that's buying and selling the real estate on behalf of the people performing the exchange. It doesn't feel like that practically. Practically, it will feel, if you're doing a 1031, it'll feel just like you're the seller, and then down the road, you're the buyer. You're listing the property, you're working with an agent, you're negotiating with the buyer, you're working with a settlement agent. There's just a few more layers of paperwork on top that sort of convert it into a 1031 exchange. But this top bullet point here is really, really critical. You, as the seller of the 1031 asset, cannot receive the money from sale. As soon as you receive the money, the game is up. You've recognized income, you're paying taxes, the 1031 is no longer possible. So, in addition to creating that paperwork legal distance between the seller and the sale, we also hold the sale proceeds in what's called a qualified escrow account. And that's an account in the name of our client, but they don't have access to it. They can't pledge it as collateral. They can't draw from it. They can't borrow. It's money in their name that they have no real right to during the exchange window. That's the legal role we serve. The practical role we serve is what I'm doing here, which is to educate people about this kind of opaque and not particularly sexy part of the tax code and tell you how to navigate the process without tripping over any wires. And then why you might do this, not just today, but down the road. Where are you trying to go, and how does this play into your long-term plans? That's the real service we offer, is helping people navigate a complicated web of potential IRS rules and give them some peace of mind along the way. We also document the exchange. We do this for two reasons. One, because you're going to have to file it, or your accountant's going to have to file it, and it sure is easier to file if somebody can hand you a stack of paperwork and says, here, this is what you need. Also, because every exchange is a potential audit risk, every single one. Audits are rare, but they happen, and you need a very well documented exchange to survive an audit. And just as an amusing anecdote, the IRS is terrible at audits. They're bad at lots of things. They're understaffed and overworked, and nobody likes them. But their agents have to know so much about so many parts of the tax code that they're often wrong about their own rules. And we've had to educate IRS agents about what's available, what rules apply in a 1031 over and over and over again. And we're very proud. Over 32 years, we've never had a client fail an audit, not once. Knock on wood, the next 32 years will be the same thing. And then we're also the quarterback or the coach for the whole process. We don't want anybody else to have to be a 1031 expert. We want to work with your investment advisor, your attorney, your broker, the other party is the settlement agent. Let us coach the process. That's what a qualified intermediary is there for and should do. Okay, now I mentioned at the beginning that we might lightly touch on some advanced exchange topics. So we're going to do that here very quickly. But before I dive into this, I'm just going to say everything I'm going to cover here, I'm going to go through it at a pretty brisk pace, is just for you to know about what's possible, and that it tends to be complicated, and then it tends to be more expensive than normal 1031 exchanges. That's really what I want you guys to walk away from this knowing. So in a normal 1031, you sell a property, the intermediary holds the money, you buy a new property, the intermediary sends the money to that closing, you defer your taxes. In a reverse 1031 exchange, the opposite happens. You buy a property first, then you sell a property, then your exchange completes. Now, there's a rule the IRS has that says you can't own the property you want to buy and the property you want to sell at the same time. That makes it really hard to buy first. So to get around this, here, I'll jump ahead here. Wait one moment. Oh, I don't actually, we must have cut out the slide that walks through the procedure, which is all for the better. It's super complicated. To get around this, what some very clever attorney a long time ago discovered, and he's, an unnamed hero. Nobody knows who first conceived of how to conclude a reverse 1031 exchange. He said, okay, you can't own both properties at the same time. So I'm just going to have a new LLC drafted, and that new LLC is going to go buy the property that you want to buy and hold it for you. Then after your sale takes place, you're going to do what looks like a standard exchange, going out of the property that you want to sell into the property that's been captured and held for you. In a nutshell, that's how a reverse 1031 exchange works. Now, it's not particularly straightforward for lots of reasons. One, just setting up an LLC to buy a new property isn't enough. The LLC has to have money to buy the new property. The LLC has to enter into a purchase and sale agreement with the seller of that property. The LLC is going to own the property for some period of time, which means it's going to be responsible for managing the property, insuring the property. There's lots of practical things that get in the way of a clean, have somebody else buy it, and then later on you buy it from them to make your exchange work logic. And lenders really tend to dislike that whole thing. So if you're going to borrow money to buy a new property, a lender might say, George, I'm happy to loan you $1 million to buy this property, but I'm not going to loan $1 million to this LLC to buy a property on your behalf on the hope that at some point you're going to buy it from that LLC. Now, we're pretty good at convincing lenders to go along with reverse exchanges, and there's a known formula for conducting reverse exchanges nowadays that almost every intermediary that facilitates these follows. But bottom line is they just tend to be much more hairy, much more quickly, and they're a bit like snowflakes. Every reverse exchange is a little bit different because of all the underlying fact patterns that you have to navigate. But if you're someone who's in a hot market and you found an asset you just love and you know you're going to sell down the road, it's a really useful tool. Or if you're in a spot where I'm under contract to buy in July or to sell in July and buy in August, and then my sale contract falls through and I have to put it back on the market and I can't find a new buyer very quickly, what do? Well, in that case, a reverse 1031 exchange might make a lot of sense. Now, reverse 1031 exchanges have their own safe harbor rules. That is, you still have to identify what you're going to sell within 45 days of the acquisition of the new property. That's usually pretty easy to do. And you only have 180 days to complete the reverse 1031 exchange. That is, from the date the new LLC buys the replacement property and holds it on your behalf to when you eventually acquire that new property from that LLC. You only have 180 days to complete that process. For most reverse exchanges, that's not that difficult to work with. And just to open up a door very quickly and then close it, it's possible in a reverse exchange to go past 180 days. In fact, we've seen reverse exchanges go as far out as 2 years for some structures. But you need to tread carefully because you'll lose a lot of the safeguards that the IRS has put in place for you when you do that.
I have a question. I know you don't
Yeah.
want to spend too much on this, but this was just brought to my attention recently. I didn't know it existed, but so you have to, okay, you have a property you know you're going to sell and you want
Mm-hmm.
that to be a 1031, but you found
Yep.
something that you want to buy before that happens.
Yes.
You go and you buy it with a different LLC, and then you have to sell it, like you have to physically sell it to once.
It's a good question. So we may actually have a slide on this, but maybe not. We don't. Okay. So let's imagine here's a very common, very simplified reverse 1031 exchange. Guy comes to us and says, I'm going to be buying a property in 2 weeks, and I'm going to be selling a property probably in the next 3 or 4 months because I have a lease in place and the tenant's not going to move out in time. I have to fix a wall after he moves out. So we think the next 3 or 4 months we're going to sell the property, but I want to defer taxes on that sale and I only want to buy this property that I'm under contract to buy in 2 weeks. Okay, fine. So he doesn't set up the new LLC. We set up the new LLC because he can't be the owner of the property he wants to acquire, even under a different name. So we
Got it.
create a new LLC, and he's already under contract to buy this new property. So what he does is he assigns his right as buyer in the contract to the new LLC that we've set up, and the new LLC we've set up is now the new buyer for that property. And if he has a lender in place, that lender has to be convinced to allow this to happen. Most of the time, we can convince them to do that. And then after his sale takes place, so the LLC has bought the property in a couple of weeks. We wait a few months for his sale, and then the sale takes place. At that point, he can either deed the property from the LLC we created to his name, wrapping up the 1031 exchange, or a faster and cheaper way to do it is we can just make him owner of the LLC. We can
That's
assign
all.
100% of the membership interest in the new LLC to him, and the LLC only owns one asset. If he owns 100% of the LLC, he legally owns the underlying asset as well. And that's a valid way to wrap up a reverse 1031 exchange. I should also highlight that that period between the LLC buying the new property and the old property being sold, when the LLC is on title to the new property, we, as the owners of the LLC, we don't want to manage that property. We don't want to lease that property. We don't want to improve that property. So there's a master tenant agreement put in place to where the person who is conducting the exchange is made effectively the de facto owner. They're the owner in every way but legal title, and they manage everything even during the exchange window.
Yeah, they
That's
bring
the
whatever
a normal
money's
way a reverse
needed.
wraps up.
They
Yeah,
make all the decisions. They bring whatever money's needed. They do everything essentially. Got
that's
it.
right. That's right. They can sublet the property. They could, they could tear it down and rebuild it if they wanted to. In fact, that's actually a good transition point. So let's talk about another scenario that gets kind of complicated quickly, and that is what happens if you want to buy a new property and use some of the money from your sale to improve it, or maybe it's raw land and you want to build a brand new, new build to suit project. That's possible, but it's not straightforward because there's two rules. The first is, remember, like kind for like kind. Real property is sold, real property has to be acquired. Well, if you use some of the money to pay for contractors to bring materials to the site and build a new property, the IRS says you're not actually buying real estate, you're buying labor and materials. That's not the same thing. So the money used to pay for the building of the new property or the improvement of the property doesn't count. Also, when you do a 1031 exchange, remember you want the market value of what you buy to be worth at least as the market value of what you sold. Well, let's imagine a scenario where I'm selling for $1 million and I buy another property for 800,000, but I want to put $200,000 worth of improvements into it to make it $1 million property so it satisfies my 1031 requirements. Well, any improvements made to the property after the 1031 is over don't count toward its value. It's the market value at the time of acquisition that matters. So, how do you spend money on labor and materials or improve the value of a property in an exchange window in a way the IRS views as valid? Well, it's actually really similar to a reverse exchange. What would happen in that scenario is, say, George, you want to improve a new property. You say, Sean's company is going to create a new LLC. That new LLC is going to buy the property that I want to buy, whether or not I've sold first or not, because you can do a reverse construction exchange or a forward construction exchange. That new LLC is going to buy the property that I want to improve. That LLC, after it buys the new property, is then going to borrow money, maybe from me, maybe from a lender, maybe from my exchange account, and it's going to use that money to pay for contractors to make improvements to the property. Then, after the improvements have been made, George can buy the replacement property at that point. And now, since it's already been improved, he's just buying real estate. Now you're buying $1 million property and not $800,000 property. So, in a nutshell, that's how a construction exchange works. There's a ton of potential nuances and complications and fun variations of construction exchanges that we're not going to get into here. But it's almost anything that you want to do in a 1031 exchange in terms of the chronology of the closings that you have or what you want to do with the property that you're acquiring. There's almost always a creative route to making it happen. You might have to pay a little bit more along the way. You might have to make some compromises along the way. You might have to follow some annoying rules along the way. But there's almost always a way to navigate to where you want to go and still comply with 1031 rules. You just want to make sure you're planning in advance and working with somebody who knows what they're doing. Okay. Now, construction exchanges have the same deadlines. One thing to note here, this middle bullet point. Let's imagine a scenario where George sells for $1 million. He has our LLC buy a property for $800,000, and then he's going to make $200,000 worth of improvements before he wraps up his 1031 exchange. And he's running late. Maybe it was winter when this happened, or there's a supply chain shock and you couldn't get the materials you wanted, or the subcontractors you were working with sucked and you had to find new ones, right? Which happens a lot. So before your exchange deadline ends, you're like, well, shoot, I'm just going to prepay for all of these materials, have them delivered on site, and call that good. That doesn't work. The capital improvements that you identify that you're going to make for your exchange have to be completed by the time the exchange is done. And just dropping material on site doesn't work. It only counts toward the value of the underlying real estate if it's permanently affixed to the real estate. So that lumber and that stone and that granite that you had delivered on site, it's not attached to the real estate, not in a permanent way, doesn't count, unfortunately. That does screw up a lot of construction exchanges.
Just bolt it to the concrete.
Yeah, in fact, there's a whole long literature you guys could probably spend if you're struggling to sleep some night. Go through a rabbit hole and trying to figure out what counts as permanently affixed to the property and what doesn't. And there's been some unfortunately, some intellectual bloodshed over what qualifies and what doesn't there. Okay. As I mentioned before, chronology, it's possible to structure, let's say you're buying and selling multiple properties at the same time, which is pretty common for portfolio investors. You can have it structured to where you go buy, sell, sell, sell. However you need to arrange the closings, there's always a way to structure the exchange to satisfy that. Doesn't always mean it's easy, but it's possible. And we tend to call this blended 1031 exchanges. Just driving home the point again that almost anything you want to do is possible within the basic parameters the IRS have set, as long as you're working with somebody that knows how to navigate it. Okay. So final takeaways that I want everybody to have here. First, 1031 exchanges are a powerful tool, especially, and there's no other tax rate like it in the code. No other type of investor gets the tax advantages that a 1031 brings, and only real estate investors can take advantage. In the real estate world, only real estate investors can take advantage of 1031 rules. But it's an imperfect tool. It's imperfect because the IRS fundamentally doesn't want you to not pay taxes. They want you to pay taxes. So they put you in this narrow box. And it's imperfect because 1031 exchange legislation is more than 100 years old at this point. The first 1031 rules were passed shortly after the income tax was passed, I think back in the, like 1917, 1918, that range. So over that 100 years, lots of modifications have been made to this rule or that one or this fact pattern. And you have this Frankenstein's monster of a process that you have to wiggle through. Punchline there is 1031s are complex. Don't try to navigate it on your own. You can't legally anyway. So just work with somebody who can simplify it for you. Tell them what you want to do, where you're trying to go, and let them figure out how to get there for you. And then again, they can be structured very creatively to fit many fact patterns. So, if you think it probably won't work, maybe it won't, but call somebody up and ask. Figure out if it can. Okay. And then that's the end of my presentation here. What I'll do is I will put my contact information in the chat for everybody, so you can copy and paste that and reach out to me anytime with questions. And then, do we have any while we're here? Are there any other questions that I can answer right now?
I know there's a couple we didn't address,
Okay.
and there's some coming in now, but can a 1031 of a multifamily rental property owned by a developer? Hold on. Can you 1031 a multifamily rental property owned and developed by a 50/50 LLC from the developer and an investor?
Okay. So can you 1031 exchange out of a property? Run that by me one more time. Make sure I'm following this.
Yeah, from what I understand, it sounds like developed a property that's a developer. So I think you kind of answered that, but
Here, if I go into the chat, can I find the text of that?
yeah,
Yeah.
it's in the reply.
Oh, I see. I found it. Okay.
Yeah.
So can 1031 a multifamily rental owned and developed by a 50,000 owned and by a developer and an investor? Yes, you can. So what matters is the underlying owner of the real estate going to be the seller to start the exchange and the buyer to complete the exchange? And does the use pattern for the underlying real estate fit the long-term business or investment use requirement? And did you trade into qualified real property that's worth as much as it needs to be worth? If you follow those fact patterns, then yes, you can. Absolutely. So you can 1031 into and out of virtually any kind of real estate with virtually any kind of ownership structure, as long as the underlying intent and values match up and you do it within the timeline requirements.
Okay. One of the other questions that came in, what's a typical fee?
It depends on what kind of 1031 you're doing. So for a standard, straightforward, I'm going to sell and then buy a property one for one, you can expect a fee somewhere in the $900 to $1,500 range. Most 1031 exchange companies do not publish their fees. We do. It's becoming more and more common to do that. Our standard fee is $1,250 for a one-for-one exchange. And if you're buying and selling multiple properties, then the timing and ownership matters there in terms of what the ultimate fees are going to be. If you're doing a reverse or a construction exchange, you should be prepared to pay somebody who knows what they're doing, at least $6,000 to $10,000 for those structures. And I've seen very complicated construction exchanges get as high as 20,000. That's uncommon but possible. The what you need to find out before you go down the 1031 route is, what's my tax liability if I don't do a 1031 exchange? I'm shocked at how many people call us up and don't know the answer to that question, which means they don't know the value of our service yet. And we can't tell them that. We can walk them through some back of the envelope math, but you should try to get a rough sense of what your adjusted tax basis in the underlying property is, and then how much the IRS and the state you live in are going to try to wax you if you sell without a 1031. And then compare that to, can you find a property in time, and how much is the fee cost? Now, compared to the IRS, every 1031 company out there is a screaming deal. I'll tell you that. The amount of taxes that you're going to pay are going to far exceed the cost of a 1031. So what you really need to evaluate is, am I getting enough value from the additional equity that I can roll forward into my new investment across time to offset the fee that I might have to pay and the rules that I have to navigate to do the 1031? We can help you think through that problem, but can't answer it for you. That's a long way of saying a typical fee is about $1,000 to $1,500. But whenever someone asks about fees, I like to bring in the bigger picture, because fee is important. But in this industry for this service, I think it's like the third or fourth most important variable. Your long-term plans are by far the most important variable for doing a 1031.
Yeah, honestly, I assumed the fees were much higher. Um, I've been the buyers of these when we're doing a syndication and we have the 1031s, and the amount of time you guys spend on it and all the back and forth and making sure everything gets done properly. Yeah, that doesn't seem expensive at all.
Compared to normal
And
broker
plus the
commissions and
savings.
closing fees, they're pretty cheap.
Yeah, yeah. And plus, the amount you're not paying in taxes if it's a significant 1031. Yeah.
Mhm. Exactly right. Any other questions I can answer for the folks here?
Yeah, we have a last one that came in.
Yeah, since the 50% owner is a developer, thought you said they are not qualified to 1031.
So it depends on, if you've already been classified as a dealer by the IRS and you're the sole owner of the property, it's harder to argue that the property that you're selling is going to be eligible for a 1031, because you've already been classified as a dealer. So most of the real estate that you hold is going to be called inventory and not a capital asset. But it's possible to be a dealer who also has a buy and hold strategy on the side of their assets. And there's lots of people that maybe they'll do some fix and flips, or maybe they're a developer over here, but they have other investment property that cash flows for them and they hold that for a long time. So just being a developer in and of itself does not make the next sale de facto ineligible for a 1031. It really, the fact pattern matters. And here in the example that you drafted, if the developer is a 50-50 owner of this LLC, then that LLC is a different taxpayer than the developer is. That taxpayer, that separate LLC taxpayer, hasn't been classified as a dealer, at least not to my knowledge in this example. So even if one of the underlying partners is a developer, that doesn't matter, because the taxpayer performing the exchange is not a developer in that sense. It just happens to be partially owned by one. And in the scenario that you just presented, I wouldn't have a lot of concern about it qualifying for a 1031.
And I know you use developer in the slide, but I don't know if, because I mean, there are developers that build to hold, not
There
necessarily.
certainly are. Yep, there
So I think
certainly
it's
are.
more the intent of what you're building it for, maybe. Is that
Exactly right. Exactly right.
okay?
Mhm.
This is an interesting one that just came in. So, can you exchange into a single family rental, then convert the property into a primary residence?
Yep. This is a great question. I'll try to keep this simple because the IRS doesn't make this very easy. The short answer is lots of people do this. So the classic case is, I've been an investor for a while. I sell a single family rental. I'm getting kind of up there in years. I want a vacation home, or I want to retire in Vail or in San Diego or Miami. So can I sell my 1031 property, buy another investment property, and then convert that one into my primary residence? Yes, you can do that. Now, there's a revenue procedure, and I'm going to, off the top of my head, I think it's revenue procedure 2002-86, but it might be a different one that talks about exactly the fact pattern you have to follow if you want to do this and guarantee the IRS is not going to challenge it. So you do a 1031 out of your single family rental into another investment property, another qualified like kind property held by the same taxpayer of the right value identified in the right time frame, all the rules. Then after your exchange is over, you want to wait 2 calendar years before you move into it. 24 months after the conclusion of the 1031 exchange. Then you want to make sure for each 12-month period in the 24-month wait, you're renting it out for at least 10 days a year. And you want to limit your personal use of that property during those 24 months. There's more detail to get into, but you can do it, and then you convert it to a primary residence, and converting it to a primary residence is not a tax event. There's no sale taking place. You're just changing the use pattern. You don't notify the IRS this is happening. You just stop depreciating it on your next tax return because it's not an investment asset anymore. And the IRS doesn't send agents, searching through mailboxes and knocking on windows to make sure you're using it the way you say you're going to use it. But if you get audited, you want evidence to suggest that you follow the rules. So I suggest keeping a journal if this is your plan. But the reason you might want to do this if you're not going to retire there forever is you might think, wait a second, if I 1031 into a property, convert it to a primary residence and live in it, and then I sell it, I can use my Section 121 exemption to eliminate a bunch of the capital gains taxes. Because under Section 121, the first $250,000 or $500,000 if you're married and filed jointly of capital gains is totally exempt upon sale. You could walk away after closing and use the money however you want. Well, you used to be able to do that cleanly, but you can't anymore. Now the IRS is going to prorate the capital gain according to how many years your investment was an investment and how many years your real estate was a primary residence. And let's just say it was an investment for 10 years and then a primary residence for 5 years before you sold it. 2/3 of the capital gain in that scenario are not going to be exemptable under your primary residence exclusion. That you want to get an accountant involved there. You should talk to a 1031 expert if that's going to be your plan, both before you hatch it and then before you convert to a primary residence, just to make sure you understand how the math works. But it's possible. Lots of people do that.
Interesting. I just learned that. Okay. That's a good one. It's how firm is the 2-year wait?
Well, 2-year wait, you could mean several different things here. So if you Google hold and duration for 1031 exchanges, you're going to see 2 years crop up usually in 3 contexts. The first is a misnomer that you have to hold property for 2 years either before you sell it or after you buy it for a 1031. And generally speaking, that's not true. So you can just kind of ignore that. Not firm at all. If it's a buying and selling property from related parties, there's often a 2-year requirement if you're swapping properties with a related party. That's very firm. You want to make sure you hold the property for 2 years in that scenario. If you're talking about the 2 years where it's a primary residence conversion, if you want to guarantee that the IRS is not going to challenge, retroactively disallow your 1031 exchange, it's a firm 24 months. Not just 2 years, but 24 calendar months from the end of your exchange. Now, you can argue life circumstance changes. So as a scenario where, let's say, you and your wife are in your 60s and you do a 1031, you wait a few years, you move into a new property, and then, God forbid, your wife passes away 8 months into moving into the new property and you just don't want to live in that home anymore. Can you just sell at that point and claim, to change life circumstances? Almost certainly yes. Almost certainly yes, you can. Or, you have a kid has to move back in home with you and you need to find a bigger house suddenly, or you lose a job and you have to move. Like there's lots of reasons that you might have to circumvent the 2 years, but you need a good argument if you're audited.
Okay. I don't see any other questions coming in. I've got one. Just curious, but these advanced ones that you mentioned where you become the owner, have you ever had one of those fall apart in that where you're the owner?
Yeah. We have,
Huh.
reverse and construction exchanges can fail. And that obviously presents a risk of, what happens to the property that I wanted to buy if I'm the investor, and what do we do with a property that we don't want to hold? Every reverse exchange or construction exchange contract, which is called a qualified exchange accommodation arrangement, has a line in there that says, one way or another, you, the taxpayer trying to execute this 1031, you're going to end up with the property. Either you're going to complete an exchange and transfer the property into your name and wrap up the 1031, or you're going to fail the exchange. And as soon as your exchange is no longer valid, we're going to deed the property to you at the same value we acquired it. So there's no capital gain or loss for us. So there's no circumstance where you don't end up owning the real estate that was captured by our LLC at the beginning of the process. There are just circumstances where you own it and don't pay taxes, or own it and do.
Yeah. No, that makes sense. Okay. I think
Anything
we got
else?
them all.
That was a bunch of good questions. I appreciate that, everybody.
Thank you, Sean. I appreciate it. I learned a lot, so I hope everybody that attended did as well. And then like I mentioned in the beginning, we'll have our live meetup next month, and then the month after that, we'll have another webinar. So stay tuned. Once again, Sean, thank you.
Okay. Real pleasure.
Yeah,
Thanks for
thank you,
hosting
Sean.
me. Have a great evening, everybody.